All right, my friends, so I just did a video on pension lump sum versus pension options for FedEx employees. We talked about the traditional pension plan or traditional benefit plan, traditional benefit pension, whatever it's called, and the PPA, the portable pension amount. And FedEx does it nice. They give you an option to roll over some of your money into an IRA if you want. Not all of it, but to some of it, which is a very good option. But what happened was when we were looking at the guy's account, and this is a guy I was working with. Let me just make sure this is dried up. We were able to ascertain what his payout rate was and compare that to going into the private market and buying your own annuity, i.e. pension. And so let me show you what I'm talking about. So he has hold this, it's still kind of dry. Hold on. Here we go. There we go. Yeah, get that nice and dry. All right, so he's got $172,000 is his rollover option. He can roll that over. Or if he wants, he can get $894 a month on his life, or $788 survivor. That's called a joint and life survivor annuity, JLSA, or I think they call it JSA. All that means is as long as he or his wife is breathing, they're gonna pay $708 a month. Does that make sense? So we take our trusty calculator and we say $788 a month times 12. That gives us $9,456. All right. And we divide that by 172,000 to give us our payout rate. In that case, I think it's roughly 5.5%. All right, so he's getting a 5.5% payout rate for either he and his wife, or just his wife. If he dies tomorrow, his wife still gets that amount. If he lives 100 years and his wife dies tomorrow, he still gets that amount. If they both live 1,000,000 years, they both get that amount. Nothing changes as long as he or his wife is breathing. I hope that makes sense. That's why it's a joint annuity, because as long as one of them is alive, they're getting that. On the other hand, we take this, $895, this is just on his life, times 12, 10,740. Again, we divide that by 172, which gives us a payout ratio of, I think it's like 6.2%. Yeah, 6.2. Both those payout ratios are insanely good for a guy who's not even in his 60s yet. I'm telling you, man, if you can get a payout ratio on your life of 6.2 or on a joint life of 5.5, if you're not even in your 60s, take it, because that's a smoking deal. In this case, so the drawback is it's just based on his life. And as a man, and I think he might have been older than his wife, I can't remember, there's more risk, because if he doesn't live as long, then she will be stuck with nothing in this case. So she'll get nothing if he dies next year. So I don't like that. I say, sacrifice $107 a month. That's $1,200 a month to get the joint and life survivor annuity. Now, if you look at private annuity contracts, you'll probably have a payout of 4.5 and probably 5, maybe 5.2 to 5.5. I doubt it's even 5.5. It's probably 5. Oops, sorry, buddy. You're going to have a lot less of a payout rate, and the reason for that is just simplicity. The FedEx is a smaller employee group. They're smaller, which means their life expectancies are shorter. The actuaries are looking at the age band of FedEx employees. They're saying the average age of FedEx employees is 52 years old. The average life expectancy of someone 52 is 30 years, whatever it is. The private insurance companies, though, it's anybody out there. It's the whole entirety of the world, not just specific to that employee group. So because of that, they have to assume the life expectancy is longer, simply because they're saying, we don't know, because it's the population as a whole. So they're going to look at the population as a whole, from young Pablo all the way to Grandpa Pablo, all the way down, and everybody in between. They look at the general population, because literally anyone can buy an annuity. In the FedEx, though, they can't. It's only people who are about to retire today or the next 5 years or something like that. They have a very small subset of the population. And because of that, they're saying our actuaries think the average person here will die in whatever the year it is. And thus we can pay a higher base because we don't expect to pay as long. I hope that makes sense. Now, the absolute opposite happens with life insurance. You never want to roll over your life insurance if you can avoid it from your employer once you separate service, because it's the same thing in reverse. The employer is going to, once you roll it over, they're going to charge you a heck of a lot more than they would from a private life insurance company, because they say, Josh, you are part of this FedEx group of people. You're all 55 years old. Some of you have diabetes, some of you smoke, but you're more at risk to shorter death, shorter life expectancy than the general population as a whole. Thus, we don't want to be on the hook for paying out a significant life insurance payment. So we're going to make sure if we do, we charge you accordingly. The general population as a whole, though, has a longer life expectancy than the FedEx group does. And so because of that, for life insurance, they don't have to charge as much because they don't have to worry about paying out, significantly in the next 5 years. The smaller the group, the more risky it is for life insurance companies, the less risky it is for the annuity companies, because a person who dies earlier is wonderful for the annuity company. A person who dies earlier is horrible for the life insurance company. They're literally at competing odds. I'm telling you right now. The life insurance company wants the people to live a long time so they can collect the premium, and a lot of those people will drop their policies anyway. The annuity company wants the people to die early so they don't have to pay out for many years if they weren't prepared financially to do that. Long-term care is the exact same thing when it comes to life insurance in terms of they're competing. Long-term care providers hope you die so they don't have to pay you. Life insurance people hope you live so they don't have to pay you. Does that make sense? And that's the difference between buying an annuity or buying a life insurance product through an employer versus through in the private market. Generally speaking, you're going to be much better off getting your annuity through your employer instead of rolling it over, just doing a lump sum, just doing an annuity or a pension, and you're going to be better off getting life insurance through the private market because of what I just said, mortality tables. Hope this helps. All right, we'll see you.